Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Thursday, March 12th, 2026, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story right now is the oil market shock we're witnessing. Oil prices have surged back past $100 per barrel as the Iran conflict has disrupted shipping through the Strait of Hormuz, and the International Energy Agency is calling this the largest disruption to oil supplies in history. This is creating significant ripple effects across markets. We're seeing stock futures decline as investors weigh the dual pressures of rising energy costs and the ongoing US government shutdown. The energy sector is obviously benefiting from these price spikes, but there's real concern about what sustained high oil prices mean for inflation and consumer spending. We're also seeing some interesting corporate developments. Oracle reported what they're calling hypergrowth of 22%, but the company had negative cash flow of $24.7 billion, which is raising questions about the sustainability of their AI infrastructure investments. Meanwhile, retail earnings are sending mixed signals. Dick's Sporting Goods issued weak profit guidance as they work through the Foot Locker merger integration, while Dollar General is seeing their fastest growth in a key sales metric in 3 years, though the stock is still falling on margin concerns.
That oil situation is particularly concerning given where we are with inflation. What does this mean for traders and investors trying to position themselves right now?
The key is being selective and understanding the cross-currents. Energy stocks are the obvious beneficiaries here, but you need to be careful about chasing the rally at these levels. The real concern is what happens to consumer discretionary and transportation stocks if oil stays elevated. Airlines are already seeing jet fuel costs spike, which means ticket prices are going up and margins are getting squeezed. We're also seeing some defensive positioning in the bond market, with long-term government bonds selling off on deficit concerns related to war spending. For traders, the volatility creates opportunities, but risk management is critical right now. The geopolitical situation could escalate further or de-escalate quickly, and either scenario would create sharp moves. I'd be watching the dollar closely as well. We're seeing gold tread water despite the safe haven demand, because margin calls and a strong dollar are offsetting some of that flight to safety. The market is clearly in a wait-and-see mode, trying to assess whether this oil shock is temporary or the beginning of a sustained supply crisis. Sectors like industrials and materials are particularly vulnerable if we see a broad economic slowdown from these energy price pressures.
That selectivity is going to be key in this environment. Steve, let's get into the economic numbers. What's the picture looking like from the data side?
Thanks, Robert. Earlier this week, we got some important readings that are shaping the current economic narrative. The Consumer Price Index came in right at expectations on March 11th, with the actual reading of 326.79, matching the forecast exactly up from the previous 325.25. That's keeping inflation concerns front and center for the Federal Reserve. We also saw existing home sales data on March 10th, which actually beat expectations at 4.09 million units versus the forecast of 3.89 million, and up slightly from 4.02 million previously. That's a positive sign for the housing market despite the higher rate environment. Now looking at today's releases, we have three key indicators. Initial jobless claims is the first one, and this measures the number of people filing for unemployment benefits for the first time. This is a critical real-time indicator of labor market health. We're also getting housing starts and building permits data today. The forecast for housing starts is 1.35 million, down from the previous reading of 1.404 million. This will give us insight into whether the residential construction sector is slowing as builders respond to affordability challenges. The third indicator today is the trade balance, which shows the difference between our exports and imports. The forecast is for a deficit of $66.6 billion, which would be an improvement from the previous $70.3 billion. A narrowing trade deficit could provide some support for GDP growth. Looking ahead to tomorrow and the rest of the week, we have a packed calendar Friday, March 13th. We're getting the GDP report with a forecast of 1.4%, down from the previous 4.4% reading. That's a significant deceleration and will be closely watched. We're also expecting the PCE price index tomorrow, which is the Fed's preferred inflation gauge, with a forecast of 0.4% matching the previous reading. Consumer Confidence Index and University of Michigan Consumer Sentiment are both due tomorrow as well, with the Conference Board measure forecasted at 55 versus the previous 56.6. We'll also see durable goods orders with a forecast of 1.2%, slightly below the previous 1.4%, and the JOLTS report showing job openings, forecasted at 6.7 million compared to 6.542 million previously. It's a data-heavy end to the week that will give us a comprehensive view of economic momentum heading into the second quarter.
That's a lot of data to digest, especially with the GDP number tomorrow. Lizzie, let's shift to crypto. What are you seeing in the digital asset space?
The crypto market is showing some resilience despite the broader market turmoil, which is actually quite notable. Bitcoin is holding around the $70,000 level, and we're seeing it demonstrate relative strength versus traditional stocks, the software sector, and even gold in some timeframes. The key technical level everyone is watching is $72,000. Bitcoin has faced repeated rejections at that level, and analysts are saying this is the most challenging phase for the price action. We're seeing increased institutional interest though. BlackRock just launched a staked Ether ETF, which is significant because it shows demand for yield-generating crypto products is growing. On the positioning side, Bitcoin futures trading volume on Binance is now 5 times bigger than spot trading, and open interest is rising, which suggests cautious and somewhat bearish positioning in the near term. Options traders are actually pricing in less than 17% odds of a breakout to $78,000, and some are positioning for a potential pullback to $65,000. For Ethereum, we're seeing the price remain range-bound around the $2,000 level. There's resistance there, but the Ethereum Foundation is experimenting with new DVT-lit technology, which shows ongoing development. Wales recently withdrew $155 million worth of ETH from exchanges, which is typically a bullish signal as it suggests long-term holding rather than selling pressure. Solana is probably the most interesting story right now. The Pump.Fun platform just became Solana's first $1 billion revenue platform, which is a major milestone for the ecosystem. There are hints of cross-chain expansion, with subdomains pointing to Ethereum, Base, and other chains. Solana price is approaching $90, but there's concern about a potential bull trap at that resistance level. Overall, institutional positioning in Bitcoin remains strong, with firms like Strategy continuing to accumulate, reportedly buying 7,000 BTC this week. Retail sentiment is more mixed, with some caution given the macro environment and the geopolitical tensions. The fact that Bitcoin is holding up relatively well while oil is spiking and stocks are falling is actually encouraging for the digital asset thesis as an alternative store of value.
That institutional accumulation in Bitcoin is certainly worth monitoring, especially in this volatile environment. Well, that wraps up today's Morning Bell. We've covered a lot of ground, from the oil supply shock and its market implications to the economic data releases we're tracking and the evolving crypto landscape. Remember, do your own research and consult with financial advisors before making investment decisions. The information we discuss here is for educational purposes and shouldn't be taken as personalized investment advice. If you found today's discussion valuable, please subscribe to the Morning Bell wherever you get your podcasts, and we'll see you back here tomorrow as we continue tracking these markets. I'm Robert, thanks for listening.